Welcome to The Explainer. Today, we're tackling what is, without a doubt, shaping up to be the absolute biggest financial event of 2026. Yeah, we're talking about the SpaceX IPO. You can already feel the frenzy building, right? It's turning into total market euphoria. But what if the absolute smartest move you can make on IPO day is to sit on your hands and do absolutely nothing? Well, today we're breaking down some brilliant source analysis that makes exactly that case. And instead, it points us toward these massive, unsexy moneymakers that are basically hiding in plain sight. Okay, let's dive into this, because this quote really hits the nail on the head. It perfectly captures the paradox we're unpacking today. The analysis we're looking at, it doesn't hate SpaceX. Actually, it makes this super bold claim that Elon Musk's space juggernaut is eventually going to be the largest company in the world, literally by a country mile. But here's the catch. It insists that buying into that initial IPO hype is a massive, massive trap. So, it begs the question, how on earth can a company be a guaranteed generational wealth creator, but just a terrible trade on day one? Part 1, the SpaceX IPO trap. Generational wealth versus day one hype. So when SpaceX finally goes public, the hype is going to be absolutely deafening. The source analysis anticipates an IPO valuation somewhere in the ballpark of $2 trillion. A $2 trillion valuation on day one. Every single person is going to want a piece of history. Social media is just going to be blazing with FOMO, the fear of missing out. But paying a $2 trillion premium just to say, hey, I was there on IPO day, well, that's exactly where retail investors tend to get completely crushed.
Now, what's really interesting here is the stark, kind of shocking contrast between that hyped-up projected valuation and the actual fundamental reality on the ground right now. Look, SpaceX is bringing in roughly $18 billion in revenue. That's super impressive for an aerospace company for sure. But they're also operating with $5 billion in annual losses. If they IPO at these hyped-up valuations, you are looking at a price-to-sales ratio of roughly 100x. You are paying an absolutely astronomical premium for future growth that literally hasn't even happened yet.
And that brings us to the actual timeline of SpaceX's success. The source really emphasizes that the monumental, science fiction-level goals SpaceX has, like colonizing space or completely dominating global satellite internet, these things require decades of technological advancement. This is a 30-year process. In 2026, we're going to see that IPO day hype cycle, which is almost certainly going to be followed by a severe correction once reality actually sets in. The smart money, according to the analysis, is going to use that window from roughly 2026 to 2036 to just slowly accumulate shares. It's not until maybe 2055 that we really see it reach its full potential as the world's biggest company. So honestly, there is literally no rush. Section 2. Process over hype. Beating the FOMO. So the crucial point here is implementing a system that actually protects you from your own emotions. Enter dollar cost averaging, or DCA. This is basically the strategy of slowly building a position by investing a set amount of money on a regular, boring schedule, let's say once a month, and you just completely ignore the short-term price spikes or crashes. Think about it. If your plan is to hold SpaceX for 30 years, why would you risk a huge lump sum right at the peak of IPO hysteria? By using DCA, you optimize your cost basis over a decade. A boring, reliable system and process will basically always beat trying to predict short-term euphoric outcomes. Moving on to Section 3, the giant AI landlords, the massive moneymakers hiding in plain sight. And this brilliantly illustrates the massive, frankly, crazy disconnect in the market right now. Look at this. You have Amazon generating $720 billion in sales, trading at a price-to-sales ratio of just 3.7. Microsoft and Google, they're pulling in hundreds of billions at roughly a 10x multiple. And then you have the anticipated SpaceX IPO. It's pulling in a fraction of that revenue, just $18 billion, but the market is expected to demand a staggering 100x multiple for it. It's wild. These massive, established tech giants, these AI landlords, are historically cheap right now compared to these hype-driven alternatives. So let's break these down, starting with Amazon. The analysis actually calls Amazon the ignored AI landlord. For the last 5 years, Amazon stock has largely just traded sideways. It's actually lagged behind the S&P 500. Yet, they own AWS, which is literally the largest AI infrastructure in the world. They have all the e-commerce data, the logistics, and they're fully vertically integrating by building their very own custom Trainium chips to run these massive AI models efficiently. They are fundamentally killing it. Because they aren't the hot, new, flashy thing on social media, the market is kind of just shrugging and ignoring them. Then we have Microsoft. The source perfectly and hilariously describes Microsoft's enterprise software ecosystem as the Hotel California of B2B. You know, once a business checks in, they can basically never leave. The ecosystem lock-in is just incredible. They've got Azure cloud dominance, really heavy integration with OpenAI, massive 63% EBITDA margins, and reliable double-digit growth. Yet, in a market where you can practically throw a dart and make money right now, Microsoft stock has somehow seen a 7% dip recently. They literally own the land the AI boom is being built on, but investors are out there getting totally distracted by short-term narratives about capital expenditures.
And look at Google compared to SpaceX. Honestly, the difference in scale is almost hard to comprehend. Google generates $400 billion in annual sales. To put that into perspective, that is more than 20 times what SpaceX is currently making. 20 times. Google is growing at 15% year over year, with a massive 52% margin, and they are aggressively vertically integrating with their own TPUs, tensor processing units, so they don't have to rely on outside chip makers. And you can buy Google right now at roughly 10 times sales. For the SpaceX IPO to make any mathematical sense at its projected hype valuation, it would effectively have to trade at a multiple 10 times more expensive than Google. Let that sink in.
Let's move to Section 4 and see how this builds. Ignored infrastructure plays. The unsexy AI boom.
Okay, so pretty much everyone agrees that the single biggest bottleneck for the future of AI is energy, right? Data centers require monumental, almost unfathomable amounts of power. Yet, retail investors are out there heavily chasing these volatile crypto mining stocks, just crossing their fingers and hoping they pivot to data centers. Meanwhile, a company like Constellation Energy, an absolute leader in scalable, efficient nuclear power, is just sitting right there. It's got $25 billion in revenue, fantastic margins, and it trades at just 3 times sales. But because reliable nuclear energy isn't some viral trending topic on social media, it has basically zero hype. It is a pure, fundamental picks and shovels play for the entire AI boom.
Another really prime example of this is Snowflake, a company that provides essential cloud database infrastructure for AI. The disconnect here is just wild to see. If you look at their stock price over the last 5 years, it has basically done nothing. 0% growth. Nothing. But look at the actual business fundamentals. Over those exact same 5 years, their sales exploded from $600 million to $4.7 billion. Their free cash flow swung from negative $80 million to a positive $1.1 billion. The business itself is absolutely thriving, but the stock is stagnant because it just lacks that flashy get-rich-quick storyline. This right here, this is exactly the kind of fundamental gap that disciplined long-term investors are constantly looking for.
Section 5, the marathon mindset, rules for frothy markets. So bringing it all together, the source lays out a really strict set of rules for navigating a market that's just full of euphoria and froth. First up, completely avoid trying to trade or time the top and bottom of the market. It's a loser's game, pure and simple. Second, focus strictly on buying fundamentally sound companies and just hold them for the long term. Third, relentlessly, and I mean relentlessly, use dollar cost averaging to protect your portfolio from wild volatility and to optimize your entry prices. And finally, allocate your heaviest investments into misunderstood, totally unhyped businesses where the actual fundamentals are massively outpacing the stock price. Basically, let the crowds chase the shiny hype. You quietly secure the actual value. Which leaves us with this final, pretty profound question from the analysis. Why sprint in a 4-hour marathon? Investing in companies with 10, 20, or 30-year horizons, like SpaceX is going to be, is the ultimate marathon. Trying to rush in blindly on IPO day, paying exorbitant top-of-the-market premiums just to feel like you're part of the action, that's literally like sprinting the first 100 yards of a 26-mile race. It does nothing but exhaust your capital right out of the gate. So, as you look at the market today, I want you to ask yourself, are you buying a business based on its fundamental reality, or are you just sprinting to catch up with the hype? Thanks for joining me on this explainer, and keep that marathon mindset front and center.